Hello, my friends. This is Dr. M supporting your journey with principles of economics as we finishing up the course. Today we're going to talk about Federal Reserve, Central Bank, because we have mentioned its role in macroeconomics arena, and we want to get a little bit more details and clean up a few things here and there to have more solidified understanding of Federal Reserve role as a central bank. So I'll try to simplify this as much as possible, because as long as we understand in principle what happens, that's what is critical for us. So the Federal Reserve Federal Reserve Bank was established in 1913 and played a key role at the time. I'm going to give you a little bit of history with some illustration. Let's hypothetically think about that gold was discovered by Goldsmith. That was the name of the person who discovered the gold, hypothetically. And this Goldsmith decided to employ muscular, big people to hold and protect this gold. Obviously, for what reason? To protect, from any criminals and any people with ill intent. As this protection was executed and discovery was preserved, discovery gold was preserved, Goldsmith decided to extend and attach additional services to this establishment. In particular, he offered to hold the gold for other people. And since he already made this establishment of guarding the gold in a very successful fashion, he offered that same service to other individuals. Thus, other people liked this idea and they brought gold to Goldsmith to hold it, to preserve it over time. And for holding this, they were willing to pay some premium because that was a valuable service, some sort of a security type over this type of wealth. Now, as gold was accumulated, Goldsmith, while accepting more and more clients to hold other people's gold, Goldsmith decides to write banknotes and depository receipts. Basically, he decides to give out loans. And those loans came in two capacities. One is the banknote, and the other one depository receipts. So basically, he was giving out loans against those gold deposits that he had in hand, even though some of those deposits did not belong to him, but at the time were in his possession. Now, you can call that speculation, but that's what the role of the local bank is, in a way. Now let's look at the balance sheet for Goldsmith. The balance sheet at that point, because he has to determine how much loans he can issue, how many banknotes he can give away, and that has to be comprised against his holding of the gold. So he basically printed money against the gold that were held in his possession with a promise to pay back by gold. And that was a welcome service because to carry gold around is heavy and risky, and it was much easier to carry paper money. Let's suppose that there is $1,000 of gold value that's been deposited and kept by Goldsmith. And he decided to write $2,000 worth of banknotes and or deposits. The whole idea of this speculation is based on the fact that people do not show up for their deposits all the time. So bank needs only $50 of gold in reserves in order to run the operation. Let me drive this point home. Banking works well only if all people do not show up to get their money back, deposited in the bank. In 19th century, America, as much as many other countries, were driven by agriculture. And there was a bank run. It's a term that was adopted to describe when a lot of people attempt on a wide scale to withdraw their deposits. Now, as you see from this table, assets are not always as big as the liabilities. In fact, from this table, you can create numbers in such a way where liabilities could be written out at a greater scale than the assets available to support it. The bank panic in the United States that took place in 1907 actually led to the founding of the Federal Reserve System with one mission in mind: to provide for elastic currency. At that point, Federal Reserve was to be serving as the lender of last resort to the banking system, given the nature of the speculative business that has been explained to you. So you can claim safely that initially Federal Reserve had only one reason to be founded, and that was to lend money to the banks whenever bank run or the bank panic is set. Now, over time, this role of the Federal Reserve Bank expanded from minor to some major. In particular, one of the tools that the Federal Reserve Bank adopted is open market operations. Open market operations is when the Federal Reserve buy and sells government bonds on a wide scale. The original tool that was assigned for the Fed to use was set by the Congress. In addition to that, the Federal Reserve is in its power to set interest rate that it will charge banks to lend reserves to various banks around the country, member banks. Not all banks are members of the Federal Reserve System, but many are. If the bank becomes a member of the Federal Reserve System, there is a minimum percentage of reserves bank requires that should be held against deposit. So there are some rules, and speculation in this case by the bank is constrained. Now, let's go to some financial economics that was introduced to you in previous video sessions. In particular, recall how we calculate perpetuity. It's an annual payment that is set out forever. Present value equals you take the future value and you discount by the nominal interest rate. So in this case, A as an asset is a coupon payment in equal amount that, based on the contract, is agreed to be paid every year forever. And the P is the price, the market price at present value for the right to receive this asset in perpetuity. You can write out the interest rate in order to think about how present value and future value are related, and we have done so in the past. So that gives you a clear idea that when nominal interest rate is going to change, it will, in essence, will impact the value of presently denominated asset against the future denominated asset. So with open market operation, namely a purchase, the Fed, or the Federal Reserve, affectionately called Fed, purchasing bonds with reserves it creates for that purpose. And as a result, it's going to bid up the bond prices with open market operations. And thus, the interest rate will decrease. The nominal interest rate will decrease because the present value is going to go up. And present value and interest rate are inversely related. Open market sale is when the Fed sells the bonds, taking reserves out of the banking system as it does so. And by doing so, Fed offers bonds at a low prices, and thus impacting the interest rate accordingly. There are some other functions that the Fed does, and it also provides reserves to the banks, and it's called overnight loans. So there are different types of services that describe the relationship between the Fed and banking community. And finally, I wanted to give you this overview briefly by stating that in 1933, US dollars used to claim that gold certificate available instead of the Federal Reserve. In other words, US dollars used to be freely exchanged for the gold. At some point, US went off the gold standard, and by doing so, it changed the price of the gold from $35 per ounce to $20 per ounce. So it became less expensive, and began issuing gold certificates or currency to pay for the gold purchases. So when someone such as big and powerful is buying a lot of gold, clearly it would put downward pressure on the gold prices. In 1934, there was a Federal Deposit Insurance Corporation funded with the bank deposits in part. And basically, Federal Deposit Insurance Corporation is ensuring deposit of every individual and every entity, as long as this bank within the Federal Reserve System, up to a certain amount. And as of today, it is $250,000. So if you have this much cash, up to $250,000, the Federal Reserve guarantees and issues insurance for such deposit. And this type of the service brings some stability and liquidity for the markets to function. In 1935, the Federal Reserve Bank gets the power to change reserve requirements. Thus, its role is being expanded, and banks now, from that moment, are required to keep reserves at hand. In 1936, the Treasury still prints gold certificates, and around that time, Adolf Hitler came to power, which induced a lot of Jewish communities to immigrate to the United States with all their assets, including the gold. And you should be able to hypothesize what would happen when there's a lot of gold that is coming to the marketplace or flooded the marketplace. What will happen to the value? So in 1937, Fed decides to double reserve requirements because it was believed by the Fed that banks loan excess reserves, and that led to unemployment of 17%. 1938, the Fed cuts reserve requirements back to the previous levels, and that led to improvement of the economy. And here's the key points. The Federal Reserve played a key role in helping to contribute to the Great Depression, and was certainly sharing responsibility for recession in 1937 to 1938. In 2020, as you have experienced, the Federal Reserve is playing a key role, participating in attempt to prevent recession in the United States. Following Great Depression in the United States, World War I and World War I, World War II breaks out. And the United States decides to participate, I believe in 1943, during World War II, by sending active duty soldiers. Although it did participate prior to 1943 in support of allies, but it was more technical assistance and perhaps some financial assistance. The military conflicts typically increase employment. And that's the economic phenomena that was experienced at that time and eventually did contribute for United States to come out from the consequences of Great Depression. And at that moment, I would like to pause this video and wish you a very blessed day.